Yep, and you.
Hi, everybody. This is David Skrika of addictedtoprofits.net. With me here today is Mark Wright of INCA.V. He'll start shortly, tell us a bit about himself. So this is going to be a little different conversation than we usually have with these companies where, everyone knows I love macroeconomics, and talking to Mark off air. Actually, he's from Newcastle. My dad's from Leeds. So we were talking a little football. And so we have that in common too. But we're talking a lot about macro trends and inflation. Oh, one thing I forgot to tell you off the air, Mark, just as we started here, is actually my favorite band is the Animals as well.
Oh,
So
there we go. Another bunch of Geordies.
yeah. So anyhow, so Mark, tell us a little bit about yourself. I'm going to screen share right now. So you'll probably be able to see it, but what we're going to show to start here is long-term interest rates. So of course, inflation's been going higher, etc. So again, tell us a bit about yourself, and let's get into the macro. Like, we kind of want to tell people, like, even though gold maybe really hasn't done much, in the last few years, why the long-term outlook still looks good. And also gold has held up very well. We had a bear market in stocks last year. Most cryptos are off 50, 60% or more. So gold has actually held its own as well. But why at some point do we think it's going to break out here? So yeah, just tell us a bit about yourself and we'll get into that.
Sure. Yeah, as you mentioned, I'm from the UK, trained as a chemist. I've got my MBA, worked as a consultant with KPMG, and I actually invested in INCA.V way back right at the beginning in the early teens when it was a junior resource play in the gold space, because I'd like gold as a long-term investment, obviously. I'm actually in the operations side, VP operations, but obviously the gold market's cyclical, and the junior resource was struggling to raise funds back in 2013 for exploration. We had a fantastic property, it's still there, but we pivoted because in the Peruvian marketplace they were formalizing the artisanal sector, the small scale mines. And it was a real opportunity to get into the processing space. If you look at most gold rushes, the guys that make the real money are the guys selling the shovels. So we got into the service side of the business and actually purchase high-grade gold ore from the small-scale mines where it's not cost-effective to build processing plants and do processing in an environmentally friendly way locally. So we transport high-grade ore from around Peru and process it centrally and export the doré to refiners around the world. So that's the INCA.V space, and that's sort of my part in it. So yeah, it's been.
And I think it should be noted, there's really only another company, like, I think to my knowledge, and correct me if I'm wrong, that does this is Dynacore. Like, there's not really a lot of companies in this space.
Yeah, and we looked at Dynacore right at the beginning. They were a few years ahead of us, and really the processing is at the nexus of all of the whole formalization process, and it's a great business model. Like I said, they're a few years ahead of us. So if you want to look at a comparable to INCA.V, line us up side by side, and yeah, it's a great space to be in with a lot of other markets. And Ed Kelly, the president of INCA.V, has sort of witnessed firsthand sort of the consolidation that happens post formalization, whether it be in the mining sector and in different jurisdictions, or forestry sectors are two great examples. So the gold space in Peru, it really presented as a great opportunity, and one that we've sort of grabbed with both hands.
So I think if we can switch to the macro now, and I just don't want to talk too much about that, because with Ed, I've had a lot of conversations about your valuation compared to Dynacore, the amount of revenue you guys are doing. Like, we can talk about maybe that, come back to that at the end of the interview. But I think one thing that's been unique about the last few years is that for years, because of globalization, getting cheap products from China and the rest of Asia, everyone thought that inflation was dead. And then, of course, we had inflation go back up to 8% last year. And, of course, everyone knows, too, the way they calculate it now, they keep inflation lower. Like, I think it would have been closer to 15% if it was calculated the way it was in the, late 70s, early 80s, when inflation last, spiked. So what's happening?
I think most people as well, when you just look at the shopping basket analogy,
Oh, yeah.
I think people identify that certainly most of the products have gone up significantly more than the sort of 3% that the reported number is here in North America. And
Yeah,
it's
when
a
I
lot
was
in Europe.
Sorry, I was just in Canada and like, living in the Bahamas, everything's imported, everything's expensive anyhow. But I still see it here. Like I'll spend, say, just do a small grocery run and it'll be $100. And go, what? I didn't buy anything, But in Canada, I was shocked. I didn't think it was that much cheaper than the Bahamas. Like the groceries have gotten, like the food has gotten extremely expensive.
Dairy, meat, vegetables, and you go out to eat, and those costs are getting passed on in the restaurants.
Oh yeah, for sure. And then so like and I think that's there's a lot of reasons I think that's going to stay. Like a lot of people want to get rid of fertilizers because of whatever the climate change. Get rid of the amount of red meat being produced, or cows that are hurting again because of climate change. So if those kind of things take hold, then it's not even just a monetary phenomenon. It's like this way, they're changing the way that we make and process our food, and that will lead to higher costs. But the chart I have up now is the IRX, which is the 3-month US Treasury yield. So a lot of people, never thought rates were going to go higher ever again. And interest rate cycles, as I was telling you off air, extremely long. If you go look at them, like they went higher from the late 40s into the early 80s. They went lower from the late teens into the late 40s, the 30-40 year cycle. So of course we peaked in the early 80s and we went all the way down to zero in 2021. And now we're back up to over 5%. This IRX basically traces the Fed funds rate. And we can see that we've taken out the 2007 high. And so not only have we taken out the last cycle high, the 2018-19 high, we've taken out the prior cycle high, and we're at the highest in over 20 years. So I think this is a key shift. And as you can see, as rates went down from 81, to 2010 to 2021, it wasn't a straight line, but there were a series of lower highs in rates. Now I think we're making a series of higher highs. So even if there is some kind of big, say, short-term deflationary or disinflationary crunch, like say housing prices tank for a year, or there's a big shock in the stock market, and they have to cut rates to fight that, I don't think we're ever going back to zero on interest rates. I think we've started this kind of secular uptrend, just like I think we've started a secular uptrend in inflation as well.
Yeah, and I mean, you take a look even around the world. I mean, Europe has got significantly higher inflation rates than we're seeing here in North America, and the central banks are increasing rates. But I look at the base rate here in Canada of 5%. The central bank just maintained that rate. UK, even though their inflation rate is reportedly double what ours is, at closer to 7%, their base rate's still only 5.25, and I don't know, that's really the only thing they can use to slow the inflation.
Yeah, and the issue is right now, and I have a book coming out next year with Newsmax. It's a news company in the United States. But anyhow, I was just doing the final edit, and one thing was amazing, because I think that's going to be a problem as well, is during this kind of area zero rates that I'm pointing out here, everyone was issuing debt privately, corporations, governments, and a lot of this debt is very short-term orientated, 1, 2 to 5 years. Like the favorite mortgage in Canada is a 5-year fixed, right? Yep. And so the problem is right now, as this debt has to be rolled over, everyone's going to be in a crunch because now this debt that was issued, say, at 2% is now going to be issued at 5 or 6%. And that's a huge difference, especially when the debt is so large. Like I worked it out in the book. The combination of new debt that has to be issued at the government level, rolled over, plus corporate debt that's going to be rolled over, is 32 trillion, roughly 32 trillion between now and 2030. So wow, that 32 trillion is probably going to be rolled over at much higher rates. And I think that's the reason you're talking about the UK. They can't really raise rates much more because the interest expenditure is going to eat up too much of the budget. So they're in a catch 22 where, okay, to kill inflation, they probably need rates of 7 or 8%, but then that also kind of chokes off what the government can do. And also that's another issue, is all these governments are still running big deficits. So, okay, monetary policy is tightening, but fiscal policy, the US deficit is starting to expand again. And Canada under Trudeau is obviously very fiscally reckless. So that's another issue that's also keeping inflation higher, is okay, monetary policy is coming higher, but governments aren't tightening. Again, being from the UK in the early 80s, Thatcher did large budget cuts to rein in inflation. So you need that fiscal part of it as well to go with monetary. So that's why I think inflation is still going to be, after this kind of respite here, is going to be, headed higher.
For sure.
And
So what does that mean for investments in gold, and how do we how does the retail investor insulate themselves against some of these pressures?
I think the issue with gold, and Edward and I discussed it right now, is so you can see gold and say, well, gold is right near its highs, really. It's within 7% of its all-time high. So why aren't the gold miners doing better? Well, it's high inflation. Like $2,100 gold in 2020 is probably you need 25 or 2,600 now, right? For that, or you can say 2,000 gold in 2020 is the equivalent to 1,500 now, because inflation has obviously increased cost that much. So I think what's going to happen is, because they have been tightening monetary policy, that's kind of put a lid on what gold has done. But I do think that whenever they have to reverse course in the short term, and I'll tell you something, what I think is going to happen longer term as well, is then you'll see gold kind of move higher, because real interest rates will be coming lower. And obviously when they loosen, inflation will go back up. And I think one issue they're going to run into is, like I said, the central banks are shrinking their balance sheets. But I think the issue is, I told you about that 32 trillion. I think they're going to have to buy corporate bonds. They're going to try to put a limit on those yields. So I could see a scenario where rates don't go back to zero, but they're doing all kinds of quantitative easing to try to cap rates at the same time when inflation's increasing and, rates are staying on the short end at a high level. And I think that will cause gold to explode as well. So I think this kind of monetary tightening is why we haven't seen gold move significantly higher. So I think as soon as they loosen, and then they kind of get into perpetual quantitative easing, which will probably happen, I think, pretty shortly, within a few years. I think that's when you see the big breakout in gold. And if you look at this chart here, if you go look at like the 2016 to 2019 period, I think Edward sent me a chart like this as well. You'll see that 13 to 1400 looks very similar to this kind of 2000 to 2100, where you kind of got all these resistance, levels, where it failed. And then finally, when it broke, gold went straight to 2100 basically over the course of a year. So that would be the equivalent of it going to 3,000, once it finally breaks out. And seasonally, I don't know how much you know about seasonal trading patterns, but it tends to move starting in the fourth quarter. Usually gold has a very strong November to, March, April period.
Well, of course, with inflation as well, your dollar or your pound is worth less and less every year.
Yeah, and that's another issue with inflation, is that everyone looks like say the US dollar is strong right now, but it's still losing value. It's just maybe going up versus the pound, or versus, you're talking about the UK inflation. Okay, UK pound went to almost par last year in that panic. It went up to almost 130, rallied 30%. Because of inflation, though, in domestic terms, it's still, losing purchasing power.
And you roll some Brexit issues in on top of that as well.
yeah, and import costs and all of that sort of thing. So, so the last thing, if we can come back here, so I think we've made our argument. Just higher, higher debt, higher inflation, I think, is ultimately why you still want to be in gold and precious metals. And again, even though the stocks have struggled, gold itself, like if you look at this chart here, going back to 2016, has actually done pretty well. And since really the late 90s, early 2000s, gold's done exceptionally well. It's actually outperformed the S&P and the Dow, even with this huge rally in stocks we've had since 2009. So if we go back to INCA, I think one reason, so you're saying you want to be in gold equities, and obviously I own INCA, is, I've got your operations, the sales, the deliveries, the milling tons. If you can tell us a bit about the actual operation right now. And I always tell people you want to be in producers, and obviously you guys are refining the metal and then selling it, but same kind of thing, because you're creating cash flow, you're creating, revenue. You want to be in producers that are expanding their production or expanding the revenue at a time when the underlying price of your asset is going higher. So if you could tell us a bit about the operation now, and then we'll just end off on that note.
Well, I think what the key with the operation and, being in the sort of producing space, we have no mining risk. So if you're investing in a junior resource or a gold mining company, there's always that, you're looking at, are they finding more gold? Is the vein set to run out? What is the lifetime of the resource? What's their actual mining cost per ton? So you've got those issues. With us, being an aggregator, if you like, we're purchasing from literally hundreds of small, medium-sized gold mines that, even if one has their costs increase, or they lose a vein, you still got, dozens of others that are going the other way and finding more material, reducing their costs, becoming more efficient. And as gold prices go up, it becomes more economical to almost drop the grade that becomes profitable to move around the country to refine. So we're in a really good spot in the gold space. So I mean, if you're looking at investing in gold, are you investing in physical gold? Are you investing in gold miners? Are you in what sort of position are you putting yourself in, or are you spreading yourself around a bunch of different places? So the INCA.V model, and again, you mentioned and you've spoken to Ed about it, looking at the Dynacor model in terms of profitability, a dividend paying stock. That's where we ultimately plan on being. But it's a cash flowing business. But it's a business that is capital intensive. So we've got a lot of really good things going on right now. We've got a lot of excess capacity. So if you look at the numbers that we're producing right now, we're only really sitting at less than 50% capacity. And as cash flows increase, we can actually increase the grade of the mineral that we can purchase, and increase even further the amount of ounces that we're producing on an annualized basis. So we're in a really good spot right now.
Well, one thing I tell people as well is, with you guys is, like, I got Dynacor up right now, and they have $120 million market cap on roughly 200 million, in sales. And you guys have like a $6 million market cap. And, last month you did, 6.2 million US in sales. So it's like 8 million, roughly 8, to 8.5 million Canadian. So obviously some of the sales came, over month to month, but let's say on average you can do 4 to 5 million. And you said you're only at 50% capacity. So it just shows the type of, if you guys were to trade at the price to sales that Dynacor traded at, ultimately, it shows you the leverage you would have in the stock. And like then you said as well, yeah, paying that dividend, like Dynacor is paying a 4% dividend. They're paying roughly 12 cents a share, I think. So if you were to pay that kind of dividend, as well, the return you would get on the investment down at these prices would be like incredible. Like you could almost basically be doubling your money, every year. Ultimately, I'm not saying that's going to happen. That's just a conjecture there. But if everything pans out, and like down here at these levels, like I pick away at it just every month, by 10,000 shares here, 20,000 shares here, because I do think at some point maybe it's turning to profitability. Maybe it's when you guys are able to, really go to almost 100% capacity. I don't know what it is. Maybe it's gold breaking 2,100. There's going to be a catalyst that's just going to send this stock a lot higher. And, when I've had the stock chart up, it just really since 2022, you guys have been basically, I do a lot of technical stuff. You guys have been basing between about 15 cents and about 22 cents a share. And at some point, I think it's when it breaks that 22 to 25, technical resistance, it's off to the races, in my opinion.
And we're in such a good spot right now because to increase the volume of mineral that we're putting through the plant doesn't require any capex. We're covering fixed costs, so really it's just a case of putting the mineral in the front end, and a lot of it now drops to the bottom line. So again, I think we've done the hard yards, but Dynacor is the model to look at. Of course, run your own numbers, do your own comparisons, but that's where we're aiming for.
Yeah, and just to end off here, you guys, if you are a gold bug, if you are someone who's worried about inflation, you guys do have your own bullion shop. And I know I've had a few of my subscribers buy the bullion through you guys. And I told Edward maybe at some point when we've done a lot of marketing with you guys, but if I do another marketing deal down the line when the market's a little better, maybe pay me in a couple gold coins, rather than cold hard cash. But anyhow,
way better than cold hard cash. It's cold hard
way
gold.
better than cold hard cash. Yeah. So
you can bite it, you can touch it, you can feel it.
Yeah.
And we're going to be putting out something next week. We're going to do a sort of price match guarantee. If you can find a regularly advertised gold coin from any of the other retailers, we'll match that. So if you think the price is if you find something a little bit better, let us know. We'll check it out and we'll see if we can match it for you.
Yeah. So anyhow, thanks for being here. And actually, this was a great, because I have a service just to end off here called Stock Chart of the Day. And actually, I reproduce some of your press releases and talk about the company because you guys are a sponsor on that. So what's great about this is instead of doing my stock chart of the day for tomorrow, Thursday, September 7th, I'm just going to show this interview because we talked, I showed a lot of charts of gold and yields, etc., and your stock chart. So this is perfect. You actually saved me some work.
There we go, David. It's all about being efficient.
Okay. Thank you very much.
Thanks so much, David.